Chapter 9, Foreign Currency Transactions. So each country uses its own currency for the purchase and sale of goods and services. So between World War II and 1973, all of this was pegged to the US dollar. So as the dollar fluctuated versus gold, then it fluctuated, the dollar fluctuated also. But all the other international currencies did the same. So there was no real risk of currency gains or losses. So that in 1971, under the Nixon administration, we dropped the gold standard, and then 2 years later, the international community stopped pegging their currencies to the U.S. dollars. So there are a variety of countries that have various currency mechanisms. There's the independent float. That's us, the United States, independently floats, fluctuates freely according to market forces with little to no intervention from the central bank. Australia, Canada, Japan, Switzerland, the United Kingdom, all of those are allowed to freely float. And then there's a number of them that are pegged to another currency. Panama, Saudi Arabia, and Bahrain are all pegged to the US dollar. China is pegged to the US dollar, revaluing it. It also uses a mix of the euro, the pound, and the like. So they've got kind of a menu of variety that they currently value, and the percentage of that is all a secret to discourage speculation. So foreign exchange rates is the exchange rate cost of one currency in terms of another. They're published daily in the Wall Street Journal as of 4 p.m. and they're available online, X-Rates and Oanda. Oanda has an app that I use when traveling international. But these rates are the wholesale rates that banks sell currency to one another. Your rate to go to a foreign exchange counter at an international airport is different. And then there is a spread between what a foreign exchange counter or even a bank will buy and sell, so that they make money on the transactions. So what we're going to be looking at in this chapter is trades, either buying a good or service in a currency other than the currency that you operate in, or selling to a customer a good or service in a currency other than what your home currency is. So the spot rate is the today rate. That is the rate that we will use to translate the foreign currency transaction into our books, because our books are going to be in our home rate. In the United States, it's the US dollar. And so even if you sell to a customer in Europe for €1,000,000, you need to book that into, a debit to accounts receivable and a credit to sales, but that booking has to be in US dollars. So we will use the spot rate for that. And then there's a forward rate, is the price available today at which the foreign currency can be purchased at a time in the future. And those rates are quoted by banks. And so if you know that you're going to be getting your transaction in a specific date, you'll be collecting that €1,000,000, then you could use the forward rate to value that. Quotes are in two separate ways. There's direct quotes, and this indicates the number of domestic currency needed to purchase 1 unit of foreign currency. And then there's an indirect quote, the number of foreign currency to purchase 1 domestic currency. So what is the 1 unit? Is it the US dollar or is it the foreign currency? If it's a direct quote, then you take that exchange rate and you divide it in order to get to US dollars. If it's an indirect quote, then you multiply that factor in order to get, and I'll be doing examples of those when I get to the problems. And as I said, the foreign rates fluctuate. They also fluctuate on a daily basis. And so we, if we say that €1,000,000 30 days from now, which is when we expect to collect that million, is at a higher rate, then it says that the currency is selling at a premium if it's higher than the spot rate, or if it's lower than the spot rate, then it's selling at a discount. So export sales, import purchases are international transactions, and we're always going to negotiate as to what currency is going to settle the transaction. Because you can sell to European customers and have them pay you in US dollars. And if you value the transaction that way, then you do not have the foreign currency risk, your customer does. But conversely, that may be part of the negotiations in which they want to lock in that rate. So the exposure is that by the time you collect your sale or by the time you pay for your purchase, the exchange rate could change to your detriment. So you may not collect as much US dollars as you originally expected, or you may have to pay more US dollars than you originally expected. And so that is the exposure, that is the risk. On an export sale, the risk is that the foreign currency could depreciate against the US dollar, and then you're going to get less of it, less US dollars at the collection date. For an import purchase, it could also decrease in value, and you wind up having to use more US dollars in order to make the purchase in the foreign currency. So how do we account for the changes? So we initial value at the spot rate on the date of the transaction. So that's what we're going to be debiting our accounts receivable in the case of a sale, or crediting our accounts payable in the case of a purchase. Then at the end of every period, we have to revalue that receivable or payable to its current spot rate. And then depending upon the type of transaction and whether or not the currency has appreciated or depreciated against the US dollar, a gain or loss will be booked, which is taken to the current income statement. So in the case of a purchase, the US dollar is purchased at the date of purchase, and then subsequent to that, we have gains or losses. So for an export sale, it's accounts receivable. If the currency appreciates, then we have a gain. If it depreciates, then we have a loss. For an import purchase, we have accounts payable, and it's the opposite. If the foreign currency appreciates, we have a loss, and if it depreciates, we have a gain. So all of these are unrealized gains. They're not actual gains or losses until such time that we collect the money or we pay the money, but they are reported in the current financial statement. You can hedge this. You can get insurance for that. And there are two derivatives, they're called. to hedge foreign currency. You can either get a forward contract or a currency option. The foreign contract is that you know what date you have to settle. Either you're going to collect the 1 million euros, or in the case of a purchase, you have to pay the 1 million euros. And you can lock in a rate with your bank for that. And then it doesn't matter if the currency appreciates or depreciates, you have a locked in rate. So you have no risk from the moment you do that. But if there would have if the transaction would have generated a gain subsequent when you actually settle the contract, you don't get the upside. You have no downside, but you do not get the upside. Foreign currency options, there's a fee involved in that, and that gives you the option. You can either exercise it or not exercise it. So if at the date in the future that you have to either pay the euros or collect the euros, the transaction would result in a gain, then you just simply do not exercise the option, and you go back to the spot market and collect your gain. If, however, it was going to result in a loss, then at that point you exercise the currency option, and you're insured for the downside. And that's it.